401ks are the worst financial tool to become financially free, because if it doesn't produce passive income, which it can't, if it doesn't reduce monthly expense, which it can't, it is not getting you closer to it. Every contribution that you make is actually costing you more time.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. Today, I'm excited to welcome back my friend Russ Morgan from Wealth Without Wall Street to the podcast. He and his partner, Joey Murray, have been on quite a few times here over the past several years, and we're going to talk about an interesting topic: why 401ks are so bad for your financial independence and freedom going forward. Russ, welcome back, my friend.
Chris, I'm so grateful to be here, man. A lot of fun. Already pre-recording, but I know we're going to have a lot of fun on the show.
We almost ran out of time to record. We were just catching up all these exciting things. But I'm excited because I think, the title probably got some people's attention, why 401ks are the worst vehicles for financial freedom. And look, I wanted to do this because I just had this conversation with an investor this morning. I think a lot of people don't understand the math behind 401ks. And at your mastermind where we met for the first time face to face back in 2001, you asked the group, you said, "Hey, why don't you share the math behind this, Russ? Like what most people don't understand."
Well, here's the key: is that when I know you talk about this on the show, is that freedom exists when our passive income exceeds monthly expenses, right? Like that's when we truly have time freedom, which gives us the ability to do whatever we want to. Yeah. And if you use that equation to start off with, then every financial decision you make from that point forward becomes so much easier, right? And here's the people will say, well, I've been invested in my 401k. It's been for the last 10 years. It's been amazing. Why wouldn't I continue to take advantage of that? And I was like, I'm not here to tell you not to, but let's ask questions about what is your goal? What's the end goal? It's just like when you're looking at an investment, like you're looking at a multifamily, a mobile home park, a car wash, or whatever, you're starting to think the end, like what is going to be our exit strategy? And then we've got to build that backwards, right?
Absolutely.
So for someone who's thinking about their financial future, if they have to start with the end in mind. So if you're saying, I want financial freedom to be when my passive income exceeds my monthly expenses so that I can do fill in the blank, then I'm going to go, okay, if that's what your goal is, let's talk about that. So Chris, I'll just ask you the questions. I know you know the answers, but for the person at home listening that's sometimes emotionally tied to these things, they lose the objectivity. So how much passive income does the average 45-year-old who is putting in $20,000 a year into their 401k or whatever their numbers is, or if they're an entrepreneur and they're putting in tax catch-ups and all the whatever, doesn't matter what it is, how much passive income will that produce for them this year?
Probably zero.
100% zero, right? They cannot touch it, right? Until they're 59 and a half, or they separate service and there's some other exemption that they get. Yeah.
All right. Government's going to get their pound of flesh one way or the other.
That's right. All right. So the other side of the equation is monthly expenses. How much in monthly expenses does it reduce by them contributing to their 401k?
None.
Zero, right? If they consider it an outlay, their actually expense goes up. But people can say, well, but I don't consider saving or investing an expense. I'll go with that, but it does not reduce a monthly expense. So if financial freedom is when passive income exceeds monthly expenses and it didn't produce a passive income, it didn't reduce a monthly expense, for every dollar you contribute, are you getting closer to or further from financial freedom as a result of that contribution?
Yeah. I think the real answer is you really have no idea. You definitely can't say with certainty that you absolutely are. You don't know what it's going to produce in the future.
Well, if you're not getting closer to, you must be getting further from.
And that's great. Yeah, I used to have that written on my whiteboard. It said, if it's not moving you towards your goal, it's moving you away from it.
So when I say that 401ks are the worst, and I'm definitive in this, right? There's so many things in our world we're like, it doesn't. In this specific context, I can say, bar none, it is definitively the worst financial tool to become financially free, because if it doesn't produce a passive income, which it can't, If it doesn't reduce monthly expense, which it can't, it is not getting you closer to. And every contribution that you make is actually costing you more time, because if they could take those dollars that they were putting and they could invest in one of your transactions, right? We've invested with you. If they would invest with you and it would produce a passive income, then they would be getting closer to. So every day they put in the 401k, they have postponed, prolonged how long they're going to be not financially free.
Absolutely. And look, we're going to talk about some strategies where if you're like, wait a minute, I got all this money in my 401k. And that's one of the other things I hear, Russ, is I have some older investors. They've done very well in their retirement plans over their, several decades that they've been invested. One of my close friends, he's approaching 70. I won't mention his name out of respect for him, but he's amazing. He's a pilot. He's got a Harley. He's got a boat. I'm like, wait, you raised Porsches too? Who are you, man? This is crazy. He lived in a mobile home one time. He's like, oh, it was like a luxury lake community. Guys, every time I talk to him, he's like, he's like the most interesting man in the world, right? But he just looks like a normal dude. You know what he said to me? He's like, Chris, the problem I have now, I have all this money in my qualified retirement plans. I'm stuck having to take required minimum distributions and pay taxes that I shouldn't have to pay. And I think a lot of people don't realize that it can be a tax trap at the end as well.
Yeah, definitely never consider the taxes, and it's hard to predict. I mean, other than if you look at our national debt, right? We're obviously hopeful that Congress is going to make some adjustments. That the Senate won't pass this big beautiful bill necessarily without some adjustments in mandatory spending. But no matter where you stand on that, that the government is spending more and more every year. It doesn't matter if they're spending money on things that you want or they don't want, right? Like there's both sides of the coin there. Yeah. But all that means is that taxes at some point in time are going to have to go up. The former Comptroller General of the United States said there's a 4-letter word that's going to guarantee that taxes are going to have to double in the future. And that 4-letter word was debt.
Yeah.
He said it has to. Yeah. There is no other option for it to not to. But in order for them to pay for all the debt that they have, they're going to have to raise taxes. So if you're contributing into any sort of tax qualified plan where you're getting the deduction today, most people don't realize qualified plans do 2 things. They defer the tax.
Yep.
Everybody knows that part, but they forget the second one, is they also defer the tax calculation.
Yeah. Yeah, so let's talk.
Let that sink in.
This is what opened my eyes, because I'm a math guy. You know this. I love, and if you invest for 25, 30, 40 years and you save 25% on the front end, your tax rate's 25%, your tax rate's 25% on the back end, you make 10%, you're going to have more money if you paid the tax today or if you put in a tax deferred vehicle and pay the tax in the future.
You have the same exact amount of money.
It's the same amount. So stop and listen to that again. You're going to end up with the same amount of money unless your tax rate's lower in the future. And I think the only way that taxes are going to be lower in the future, this is my opinion, is that either tax rates go down, which mathematically they can't, or you're poorer in the future and your tax rate is artificially lower, like you're able to control it on your own. So if you're willing to have less money in the future and income, or you think the government's going to lower taxes, maybe it's a better bet if you're willing to lock your money up and roll the dice on that. Is that fair?
Yeah. I think the conversation typically revolves around the CPAs in our life, right? Who are trying to do the best job they can for us. Unfortunately, most people don't realize the average CPA has 800 to 1,000 clients.
Yeah.
They spend 10 months out of the year focusing on tax returns, doing tax, preparation.
Yeah.
And they have 2 months out of the year, November, December, where they actually can do planning, strategy.
Yeah.
But those 2 months also have the biggest holidays. They've been working for 10 months out of the year. This is where they want to take their vacations. And the reality is in the, I don't know, maybe call it 35, 40 days that they could meet with people, how could they meet with the 800 to 1,000 people? The answer is they can't. So your CPA is unable to give you tax planning and tax strategy advice. So the one thing that they typically do is say, oh, Chris, looks like you made a lot of money. What if we contributed some money to a qualified plan, right? it matter if it's defined benefit plans, these contribution plans, the
They
catch-up
love
plans,
those.
all this stuff,
CPAs love
because
those.
all they're doing is trying to figure out a way to show their worth by reducing your tax bill for that year.
Yeah.
And they're just going to kick the can down the road because the reality is in 30 years, whenever you're out there, you're that 70-year-old that you were talking about, his accountant from 40 years ago has long since retired. He doesn't have to answer for the tax bill that he's acquired.
Well, and even so, I'll share a little personal story here. So my wife and I were dealing with some challenges with our older son that you and I were discussing earlier. This was like 10 years ago. And my friend goes, we're on a bike ride and he looks at me and he was going through a divorce. He goes, do you guys like see a family counselor? I said, no, like we got a great marriage. He goes, you should go see a family counselor. Like they could really help you with this and it'll help bring you and your wife together and be on the same page. Now, it was phenomenal advice. And as we were looking at people, I had a question for my wife. I was like, do they have a successful marriage? Are they in a successful relationship? Do they have kids? I wanted somebody that had kind of walked the walk and knew the challenges that I was going through. I could say, hey, I've experienced this, and look, I've had challenges, but I can do that. Is your CPA rich? Are they financially independent? Are they doing the things that you would do? And in reality, and there's some phenomenal CPAs out there. I got a great group that I work with, but in reality, most, like you said, Russ, they're just collecting your receipts at the end of the year, saying, hey, here's some ways that you can reduce your tax bill today. They're not. Maybe they're making $200,000, $300,000, $400,000 a year, but if they don't understand these strategies, doing them themselves and are very affluent themselves, they've probably never even explored these strategies because there's no benefit in it for them, and there's probably no benefit in it for most of their clients anyway.
Well, they don't have the time, Chris. So here's the thing. I know you and I are going to be doing a tax intensive down at our lake house at some point this summer.
Yeah.
And here's what I've learned after going through, intensive after intensive with our family office, is that family office has 75 clients. Mm-hmm. They amend or change 100% of the tax returns sent to them.
Wow.
From actual CPAs that they also refer people to. So there are some CPAs that some of their clients are using that they're not real big fans of.
Yeah.
Majority of them are working with either someone that they're like, yes, great person, or they've actually referred them and they still are amending or adjusting those returns. And it's because they don't have the time. Yeah. And part of it is that they're not connected. What I've learned is that you have to tell your story. Like, especially with entrepreneurs, right? We're involved in so many things. Like, we're getting a loan on one of the investment properties we have. And my banker says to me, he's like, man, I've been working with you for the last 8 years. And every single year we do something with you, your returns are just more and more complicated. And I go, I know, bro, it's not my goal. But as entrepreneurs, we start acquiring businesses and growing things. And that's okay, right? We pay people to do the job. Well, if we're not having a conversation and explain, because that's what I've seen in these intensives, is the first thing we have people do is actually take out a whiteboard and we say, write all your stuff on the board. Yeah. I want you to describe exactly all the business structures you have. I want you to describe the incomes, how you get paid, and they put it all on the board so we have a very clean picture. And then, and only then, do we pull up the tax return. We start going through it line by line and comparing what they wrote on the board to what's on the tax return. And here's an example for me. I'll be transparent. I don't share other people's stuff. I'll share mine. Is I did this for the first time last year with our at that tax intensive with our family office. Yeah. And I had over $200,000, Chris, in interest carry forward. Mm-hmm. And for people not knowing what that means is that every single time, at the end of the year, I'd take all the things I'd borrowed money from. Most of it has been against our life insurance policies, right? I know you guys talk about that on the show a lot too. Yeah, we're big, huge believers in infinite banking, borrowing against whole life insurance policies. So, but all the things that I've acquired interest deductions for, I just like trying to get all those big receipts and like hand them to my accountant and pat myself on the back like, whew, I got them all that stuff, right? Now, once they have it, what are they going to do with it? They're going to write it off, right?
Yep.
That was not happening.
Not happening. Yeah.
I acquired $200,000 in carry forward. I didn't know that because I didn't even know how to read my own tax return.
Right.
And so our family office says, Russ, why do you $200,000 of carry forward? And I'm like, I don't even know what you're saying. And so we started going through it, and he's like, well, what did you borrow this money for? And I was like, well, I borrowed this money for investments in business. That's all I borrowed money for. He's like, okay, but why hasn't it been written off? I
Mm.
was like, I don't know. Like, and so we go in there and like go into that story. So for 2024's taxes, I was able to take all of that over $200,000 of
Love that.
carry forward that has accrued over the last 6 or 7 years and write it off in 2024. And it was only as a result of actually talking out my situation and then going line by line to figure out these little things.
Love that. I mean, that's huge.
It's
Getting to write off
humongous.
that amount of money. That's phenomenal. So, I think we probably got some people's attention about 401ks. You and I are on the same page with that. You and your partner Joey have written a book, Wealth Without Wall Street. Great title. Don't know where you came up with that one. Love that. Um, but you
Very
guys have,
unique over here.
yeah, it's beautiful. No, it's beautiful. I love it. I love it. But you have 3 steps that you help investors walk through to actually get to the point where their passive income is greater than their expenses. Let's help out our listeners. So they're like, okay, great. Now I know I'm doing something wrong, but what should I be doing? We've talked about the tax side of things. And if you want help on that, shoot me an email, chris@nextlevelincome.com, and just say, I want help on my taxes. And we'll share more on our upcoming intensive at Russ's Lake House, as well as some other resources that you can have. But walk the listeners through, well, first talk about your book that you and Joey wrote, Russ. Joey came on several months ago and talked about the launch. We got a lot of listeners that picked it up. But for those of you that don't have the book yet, let's talk about where you can get it and also kind of walk through what they'll learn in that book.
Yeah. So go to Amazon. Obviously, you can buy the hard copy. I'd encourage you to buy the Audible one because
Love that. Yeah.
we actually in the Audible version gave behind the scenes stuff between chapters that you just don't have in the physical book.
It's so good. It's like David Goggins did that the first time. It's awesome.
Yeah, and we read it ourselves. The hardest thing to do was to write the book. The second hardest thing was to read the book.
Isn't it hard to do that? I remember with mine, I was like, oh,
So
how hard
hard.
is it to read my book? They're like, stop, slow down, repeat that. I was like, this took a week. This is crazy.
It's so hard, but I have a lot of appreciation for people who have done their own Audible work because I realize how hard it is. Yeah, in the book, we break down the 3 steps: goal, plan, support, kind of the GPS, right? We're navigating somewhere. Most of us pull out our Waze app or Google Maps or whatever it is to get from point A to point B. And you're trying to avoid obstacles. You're trying to get there as fast as possible. That's kind of the way that we saw the book, as a way to give a high overview of what we saw coming out of mortgage industry and the financial planning world, where even though we had exposure to financial tools, had never been taught the things that you and I are having these conversations about. There was never conversations about how truly to become financially free. We were just told how to use other people's financial products that made them rich.
Right.
And so everything was based upon like giving people kind of a vision for what's possible. We were talking about the 401k a second ago. I do want to double click into this because some people have heard me talk about the 401 Lake House. And there's a 401k.
I want to hear this.
There's a 401k, and then there's a 401 Lake House. By the way, there is no such thing as a 401 Lake House. But I had this mentor that broke this down, and he had a condo and at the beach, and this is where it originated from. So I won't take credit from it. Don Blanton is somebody that I learned from a long time ago, and he had this beach house, and he did this a 401 condo. I call mine the 401 Lake House. And we were saying this a second ago, so I do want to do a quick comparison, then we can get into the book. But I think this is interesting. I've had a number of clients go and buy beach homes, lake homes, mountain homes, and say, Russ, I got my 401 mountain home now. He goes, I heard that it was a game changer. Or once I heard this, I told my husband we must do this, or whatever the case is. So in the 401k, right, the number one reason why someone contributes to a 401k, Chris, is what?
Tax savings.
Tax savings, tax deductibility, right?
Yeah, tax deduction, yeah.
So when I bought my lake house, right, and I started making my mortgage payments, I was able to reduce my taxes by what?
The interest on your mortgage.
The interest on the mortgage, right? Up to $750,000 indebtedness, I can actually write off the interest. So assuming my lake house or whatever second home I had was $750,000, every payment that I contributed as a mortgage payment, and that's especially in those early
Which is
years,
mostly interest the first several years.
yeah. So basically, the same contribution that I would make to the 401k that I'd make to the lake house be equally deductible, correct? So I'm even Steven right there. Another reason, especially if they're an employee, the reason that they contribute to a 401k is what?
If they're an employee,
yeah. What's another reason? They probably get a match,
yeah.
right? They go, oh,
2, 3, 5, 10%, whatever it might be. Yeah.
Yeah. My employer is contributing to it, Russ. Yeah. Chris, I would be stupid. That's free money. Yeah. And they're like, well, okay, Russ, how can you have people contribute to your 401 lake house? And I go, oh, that's pretty interesting, right? Well, one, I could rent it if I wanted it to, right? I could do a short-term rental.
Yep.
Or I could have friends that could invite people to it that could pay us to attend. Yeah. Or I could just send down CPA, the person we were just kind of, I don't want to say I was talking bad about, but I was like, saying, hey, do better, just do better. I could send them down there and they could refer me clients. And as a result, the same thing, the money that I make from those clients that they refer to me could help pay for my lake house, right? There's my match.
Absolutely.
For the last 10 years, people have experienced growth in their 401k. They say, oh, the stock markets have been going up. And I go, man, the real estate market at our lake property has gone up astronomically. Yeah. Like I bought a house.
Yeah, real estate's up 2x. Yeah.
Yeah. I bought a house.
And it's leveraged. And it's leveraged.
Yes. I bought a house in 2019 for $900,000. I sold it 14 months later for $1.1 million. That same house today would sell for 2.5.
Yeah.
I mean, so growth.
2.5x. Yeah.
5 years. The other thing is that when your clients get their 401, how does a person who has a 401k know if it's going well? They get a statement, right?
Yeah. And like, oh, look, it went up. Yeah.
Yeah, every quarter they get this statement, and I'm sure they sit down on the couch, they put their arm around their one, and they say, "Look how good we're doing. This is fantastic, right?" Like, I'm sure one of your sons, you just sit down with them and just would be like, "Hey, let's just take an evening to review my 401k statement." So for people who have 401ks, they have statements. Chris, do you know what the visuals that I have at my lake house are? I have pictures. I have pictures of them wake surfing. I have pictures of them jumping off the top dock. I have pictures of
I've seen them. They're amazing. I'm like, dude, I see you doing a. Well, I would say a 360. It was more like a 180 or 270 on your
a 180 and a crash.
Yeah.
Now, here's the thing: is that access, right? The 401k. In order to access it, I have to be over 59 and a half, right? Because we know since 2008, 2009, when the market crashed, they changed all the custodial rules of those. The conversation of in-service withdrawals went away.
Yeah.
Right? So you can't get access to the money. You
without like massive penalties, taxes, everything. Yeah.
Restrictions, penalties. How do you think I get in my lake house?
With your key, probably code.
I have a key. I can get in anytime I want to.
I love this is great. You got have you done a YouTube bit on this yet, man?
Oh yes, for sure. Like,
this is so good.
Let's talk about taxes, right? So when I actually access the money in my 401k, what type of taxes are going to incur?
Well, if you access it early, you're going to pay penalties.
You're going to pay penalties,
and you're going to pay income tax.
Yeah, type of income tax.
Highest marginal rate.
Yeah, because it's ordinary income tax, right?
Yeah.
So when you own a piece of real estate and you own it for more than 12 months, what kind of taxes do you pay on that?
You pay long-term capital gains.
Long-term capital gains.
If you sell it, or you could borrow against it and pay zero.
Right. And if it's a primary home, right, you have exemptions.
Yeah.
But okay, ordinary income tax, so rates as high as 40-something% with state income tax, as compared to 20%, 15 or 20% in the capital gains rate, right? So I'm paying half the tax. So when I sold that property that I bought for $900 and turned around and sold it 14 months later for 1.1, I only had to pay a portion of that.
Yeah.
because of capital gains.
Yeah.
Now, the opposite is like you were kind of leading to, if I die, and by the way, my CPA, I give them credit for this. I say, hey, what is the worst asset to own when you die? And the first thing out of his lips will say qualified plan.
Qualified plan. Oh yeah, I'm dealing with that with my stepfather's estate right now. Yeah.
So if you die though with the lake house, the 401 lake house, what happens?
Goes to your heirs, stepped up basis.
Step up basis. So if that
Yeah.
property has appreciated millions of dollars, they'll pay how much in tax if they sold it the same day and inherited it? Zero.
Zero.
That is ridiculous.
Yeah.
Now, the last thing that I would talk about is legacy. A lot of stuff that we're doing
Yeah.
is you were talking about before. Is like, hey, I'm teaching my son how to be an entrepreneur, how to learn sales, how to work for money and appreciate money, all those things, right? We're teaching something that's it's
Absolutely.
so hard, right? Like you can leave something behind, but the thing that you can't leave is these memories and trainings.
Yeah.
So the legacy of a 401k, what's left behind can only be that's it. When
Yeah.
in a 401k, you die with it, the only thing can be left behind is the money of
Is the
it.
money. Yeah.
As compared to the lake house, if you leave them the lake house,
Yeah.
they will have memories both new and old,
Yeah. And my,
right?
my kids even said, Russ, they're like, don't sell the house. Like my wife and I built the story. My wife's an architect. We built this house. My boys said, don't ever sell it. If you do, we want to buy it from you. I'm like, well, you better get to work making some money. But anyway, uh,
But
yeah,
there's
because they don't,
memories there.
yeah, because of the memories. And that's
Yeah.
most people listening, whether it's your grandparents' house or the house you grew up in, your parents' house that they have right now, that's what it is. I just went to our family farm up in Wisconsin when I was up there for my uncle's funeral. And yeah, it's like, they're like, well, why do you want to go to the farm? Like, you're only going to be there for like 15 minutes because I had to get to the airport. I was like, well, it's our family's legacy. It's the
Yeah.
homestead from my great great grandfather that came from Denmark, and there's memories there. It's in the family, and everybody wants to step foot and see that.
Yeah.
So
Well,
I love that.
that's the 401k versus 401 lake house, and it's just a different way to think about
Yeah,
money. Like if I'm going to contribute 4,000 a month, 401k for the next 20 years. What if I could find a lake property where my outlay was 4,000 a month, and then compare those things?
yeah,
I think it's interesting, right? Like because I saw my father-in-law do this idea.
hmm,
One, I had a mentor that kind of broke down all the stories, but I saw it lived out because my
yeah,
father-in-law in 2001 bought a lake house,
hmm,
and he literally had taken the money out of a 401k because at the time he could. He took the penalty, but he could take the money out because service withdrawal provisions still existed at that point in time. He bought this property. My wife lived in it her last year of college, and I saw our family for 15 years grew up in it.
yeah,
And it was just this beautiful thing. And eventually he ended up selling it. And all the stuff we talked about was
yeah,
true. It not only was his, growth over those years equivalent to what it would have been in the market,
yeah,
but what he got and what happened as a result of that is lifelong, right? My
yeah,
kids, they want me to drive them by the lake house that their
yeah,
grandparents used to own, and they remember jumping off that dock. They
yeah,
they remember all the fun of skiing and sleigh, all that stuff.
yeah,
None of that is true
yeah.
in their 401k. They
Yeah.
don't know what he invested in the 401k. They don't care.
Well, and even more impactful than going. Look, I put as you're going through that, I dropped the link to the book in the show notes here, so you guys can grab a copy there or listen to the podcast with Joey Murray. But I think this is more impactful, Russ, which is you were talking about how the affluent, how rich people view assets and money versus those that are poor or just living paycheck to paycheck. Like what Dave Ramsey has some good lessons. Get out of debt, do this, do that. But what I found, Russ, is you talk to a lot of financial advisors that work with these people, and they say, "Oh, buy term in life insurance, invest the difference. You'll get enough in your 401k, your qualified plans, so you can hopefully, that money gets you to, a point in retirement, and maybe we spend it down, and then you go on Medicaid, and then you're left with nothing." Well, you're talking about, with the life insurance that we haven't talked a ton about today, but you leave a legacy for your family, and you're talking about making memories and experiences. And that's really, in my mind, what life is about, is having those experiences with friends, like you, with your family, with those sorts of things. Whereas, stuff, a car, buying the latest piece of, electronics or those sorts of things, that's very, very fleeting. So
Yeah.
I think that's like what you said, as much as the money, having those experiences, money, you can't trade those for money.
Yeah, so well said. Yeah, I mean that I tell people the goal should be to be time free, but just remember what you're spending your time to do.
Yeah.
And if you're always having to work so hard to get it, and you lose the people along the way that you were doing it for to
Yeah.
start off with,
Yeah.
and there's some movements out there trying to get people to be better stewards of money. I'm for it as long as it doesn't give up the freedom that you're seeking to start
Yeah.
with.
Absolutely. We'll share with the audience, Russ. We got a bunch of links here in the show notes for everybody. What's the best way to learn more about Wealth Without Wall Street? Get a copy of your book, learn about your amazing community and these events that you guys have to help people do all the things that we've been talking about today.
Yeah, go to wealthwithoutwallstreet.com/next level. And on there, there's a number of things that you can get access to. And yeah, I would love to be able to empowering you to becoming financially free, encouraging you. We built a community that has about 9,000 people in it now. And it's amazing to see people just encouraging one another, talking about what their goals are, the plans that they're building. And we built that community to be that support resource, right? Like to help people who don't know what their investor DNA is never even considered what their investment buy box is, to be able to do due diligence on deals and to have amazing conversations with people like you, Chris. Like that is all done and choreographed through this community that has just been a blessing to everybody involved.
No, it's fantastic, and I'm a part of it. It's we got to meet a few years ago. We've become more than that now, man. It's been almost 5 years. Very grateful for that, and always grateful to have you on the show, Russ. Great to see you, my friend.
Yeah, thank you for having me.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.